George said, this is our Totally Lit, where we are committed here at OIC 10K to bring the basic financial education to our community. And tonight we'll be talking about the dime, understanding the dime concept, or you can say understanding the dime method. And dime is a term that financial advisors as well as insurance agents they use to help determine how much insurance coverage will benefit you and your family's needs. And so we can say that the dime method is a simple way to estimate how much life insurance coverage you may need. It helps you break down your financial responsibilities into four key areas. And so those areas they spell out, we can use the acronym of DIME. And so D stands for your debt, making sure that your debt is protected and covered. And I represents the income replacement, that you were clear on the strategy, or you start planning a strategy of how you can replace your income if something happens. And then M stands for your mortgage, if you are a homeowner, or it just really you can say your shelter, where you and your family reside, and where do you guys plan to reside currently and in the future. And N represents the educational needs, maybe your own or future educational needs for your family. We should all be lifelong learners and continuing to build our skills. And sometimes those skills that we need to learn in order to be productive in our time now cost money. And so it's good to have a plan in place where, hey, I have a savings, or I have a plan that will protect my future educational needs. So when we look at the debt of the dime, it includes all of your personal debts and your final expenses. And so this considers your credit card balances. Maybe you have a car loan or even personal loans that you may have occurred over the years and you're working towards paying those. And of course, your funeral expenses, whether you're looking at maybe you want to be cremated, or you would like to go through a traditional service, and those those items are not free. It's good to have a plan in place to ensure that your loved ones aren't left with your financial obligations. And this is important because when a loved one passes away, the debt that that loved one owes, it doesn't automatically disappear. And it may take years, it may take a lot away from the family, and therefore cause the family to experience some distress. So when someone dies, their estate, everything that they own, whether it's money, property, or asset, is used to pay off those debts that they owe. So this process happens before any remaining benefits are paid out to your beneficiaries. And so it's good to have that plan in place so that your heirs and your beneficiaries are clear. This is my personal debt right now, and in my absence, this is what's going to come out of the estate. But sitting with an insurance agent or a financial advisor, someone that can help you put a plan in place and make sure that your life insurance can cover these risks while you are either paying them down, but you can assure your loved ones will be taken care of because you have the proper amount of coverage. So keep in mind when it comes to debt that the estate pays first. The executor or the administrator of the estate will gather all of your assets and your debts, and they will use the estate money to pay those off first, those credit cards, those personal loans, medical bills, mortgage, and even car loans. And if there isn't enough money in the estate, some of those debts may go unpaid, causing distress. So, one thing when it comes to your loved ones, debts, you don't want them to transfer to your family because they definitely can drain the estate and what you have set aside that you would like to transfer to your loved ones. It could force your loved ones to sell precious assets that have been passed down from generations. So having the right amount of life insurance ensures that your family can grieve without financial stress, and that makes a huge difference. So that covers the debt portion of the dime to make sure that you have that properly protected with the amount of life insurance that you are talking to your insurance agent or your financial advisor to know what is my actual number. And when we're looking at the income replacement, you want to determine how long your family will need your financial support if you were no longer here. There is a formula that we use, and it's your annual income times the number of years support is needed. I have an example where if you contribute to your household, you're bringing in 60,000 a year, you want to protect up to 10,000. So just looking at income placement alone, you will need up to 600,000 of proper life insurance to replace your income if something happens. Keep in mind this provides a financial cushion and replaces your income during the transition period. Replacement means having enough life insurance to replace the income you currently earn so that your family can continue living comfortably if you're no longer here to provide. So, in that grieving process, it would be very traumatic for your loved ones to have to relocate because there were no proper life insurance in place. And as we looked at the debt portion earlier, debt doesn't automatically disappear. It comes straight from the estate. And in that process, they might have to relocate. They may have to move in with other family members to make sure that they have enough just for their day to day. And you can definitely ensure that you are leaving your loved ones in a better position and you are fulfilling all of the promises and obligations that they expected for you to fulfill by making sure that you're properly covered. Why is this important? This is important because your income covers essential day-to-day needs such as rent, mortgage payments, utilities, groceries, transportation. They already suffer a physical and a spiritual loss of you, um, and making those disruptions to the day to day will definitely make the experience more traumatic. And this is something that we want to consider how we want to leave our loved ones when we're looking at putting proper protection in place for ourselves and our future selves. Childcare. How would your child, if you have a child that's not a school age child, how would that child care be provided? Will your loved one be able to continue to work and also pay child care, school expenses, medical, insurance costs to make sure that they can continue with their proper protection and savings for the future, that they have something that they can continue to grow on? So without your income, your loved ones might struggle to maintain their lifestyle or just meet those monthly bills. So income replacement is definitely a very important factor when you're looking at what's my number and what's the proper insurance that I need. And mortgage has to do with your shelter. The M in the dime method represents the mortgage, your home loan, or any major housing related debt. When calculating life insurance needs, um, you